So I've always been a bit of a market structure geek. And so I really had a lot of fun doing this podcast today with Michael Feng, the founder and CEO of Hummingbot, which we'll find out more in the podcast episode. I love the idea of decentralizing the market maker function. Traditionally, market making has been highly institutionalized, kind of a Wall Street boys club. Of course, hedge funds and stat arb trading desks have broken this down a bit and deployed their own highly sophisticated strategies that operate at scale and are very capital intensive. Projects like Hummingbot give a bit of the edge back to smaller traders and also improve markets by narrowing spreads on issues. This is an example of letting 100 flowers bloom and seeing how trading ingenuity can democratize algorithms for trading and provide a market stabilizing function at the same time. So I hope you really enjoyed this podcast. If you like it online, share it with people you know. I think you'll enjoy it, particularly if you're a market structure geek like I am. So with that, I bring you Michael Feng of Hummingbot. Welcome to The Encrypted Economy, a weekly podcast featuring discussions exploring the business, laws, regulation, security, and technologies relating to digital assets and data. I am Eric Hess, founder of Hess Legal Counsel. I've spent decades representing regulated exchanges, broker-dealers, investment advisors, and all manner of fintech companies for all things touching electronic trading with a focus on new and developing technologies. So, really excited to have Michael Feng. He's the founder of Hummingbot on the podcast today. Welcome, Michael.
Thank you, Eric. Glad to be here.
Yeah, so for those of you who don't know, I'll actually allow you to introduce what Hummingbot is to the listener. And why don't we start off with your background story and then sort of roll into what Hummingbot is?
Sure. I graduated from college in 2001. I went to Wharton, business school at the University of Pennsylvania for undergrad. So I followed the herd of lemmings to Wall Street, like everyone did back in the day. So I actually worked in this area of finance called CDOs, collateralized debt obligations, which was an esoteric backwater when I first started. But over the next about 5 or 6 years became a pretty important part of the finance industry. Unfortunately, I had the privilege, I guess, if you will, of structuring the first CDO backed by subprime mortgages. This was called South Coast Funding, which launched in August 2013. But it kind of set off a tidal wave of similar vehicles backed by all kinds of mortgages, like residential, commercial. We threw hedge fund strategies in there, like high yield loans and bonds. And unfortunately, these securitized vehicles had a part in causing the 2008 financial crisis and were featured in the movie The Big Short. So,
and I left Lehman 1 month before the collapse. So, and for related reasons. So, thank you very much, Michael. I didn't know that you were the one who was behind it all, but now I know the great market forces.
I was definitely not the one behind it all. I was basically the first year analyst who had some really good VBA skills in Excel. That they tapped to create the models for these things. So when
Michael's like, what? You put me on this podcast to lionize me?
Yeah, no. But I would say, to be honest, I would say from that experience, it actually really just crushed me, because I did well financially, but after about 9 years of doing that, in 2010, I was just incredibly disillusioned by the 9 years I'd spent creating all kinds of really complicated products that frankly subtracted value from the economy, cost millions of people their homes and their jobs. And I just felt I was this unwitting participant to this huge debacle. And I felt like my career had frankly been wasted at that point. I actually remember I was working in Hong Kong at the time, was living in this big luxury condo and just feeling what's the point of all this? Why just continue? And so that's actually why I left finance. I ended up just applying to a master's, this engineering degree, this program at Stanford. Luckily, I got in, and so I just quit finance in 2010, and I thought I would never go back to the finance industry ever again. And I really just wanted to create tech products and do something related to engineering that would actually add value to the world instead of subtracting from it.
Excellent.
Yeah.
So that led you to
to crypto, I guess. But yeah, so,
or I don't want to skip. There might be other parts of the story.
Yeah, I mean, the basically, so I spent 2 years at Stanford, learning to code, and then afterwards, I was like, hey, let me try to find a job as an engineer in Silicon Valley. Unfortunately, my resume just said failed investment banker at the time, so I had a lot of trouble just getting even an interview at some of these tech startups. So but the good part was I had taken a bunch of like Stanford courses in entrepreneurship. That one of these projects that you try to like create some kind of startup with your friends, and I just caught the bug. I just felt like, hey, why can't I do it too? So I decided to create a company, create a startup, and then the idea was because I had spent a lot of time as an analyst in finance, like basically copying reports in PDF formats into Excel, and I was like, and the one thing you learn in these startup classes is you always want to solve this like big pain point that people have, right? And from your own personal experience. So I was like, what if I could create a tool that just like automatically extracted tables and PDFs? I could save investment banking analysts everywhere, like millions of myriad hours of like drudgerous work. So then I teamed up with my friend Max, who I'd gone to college with. He was a great engineer. He taught me a lot of like, things on how to actually really code. And so we actually created this tool. It used computer vision. So the same heuristics that your human eye uses to detect lines and boxes and columns and stuff like that. And we created a tool called DocMunch that would basically, you could drag your cursor over this like table in a PDF and would basically copy that into Excel perfectly. That was nice. However, it was more of a product than a company. We had a lot of trouble figuring out how to monetize from that. I actually remember we had a contract with Citigroup to help them. And Citigroup was like, you know what? We can't really use your PDF tool because a lot of our reports now are in APIs. We have APIs now, structured data. Where we really need help is a way to like take all these APIs and put them into a single dashboard that we can all consume. And you know what I said? I said, that's not what we do. Our business is creating PDF tools. So, you can find someone else to do that business for you. And we just want to keep on, building and selling this PDF tool that we had created. So
that's not the future.
well, so honestly, it was actually a really good experience because I kind of learned like what being an entrepreneur actually is and what it's not. So long story short, we ran that business for about 3 years, and we were acquired eventually by a company called Nitro that does PDF software. They make like an alternative to Adobe Acrobat. And
I use Nitro.
Oh, thank you. Yeah. So I became head of product.
I used to.
Yeah. So I became head of product at Nitro for a while. They hired me. They put me in charge of like a 10-person team of like product managers and designers. And honestly, I had no idea what I was doing. I was like trying to basically be a manager really for the first time in my life. And while my co-founder was head of machine learning at Nitro. So we were both there for a couple of years. Honestly, we learned a lot in terms of how to operate in a medium-sized startup. But then, in 2017, I was pretty tired of the PDF industry at that point. I felt I knew everything I had known about all kinds of various PDF configurations and standards, and I was like, this is so fucking boring. I gotta get out of here. So in 2017, that was also when the ICO.
I gotta say, what I loved about I gotta say what I loved about Nitro is because I use Nitro.
Okay, yeah.
I stumbled upon it. I'm a lawyer, and I would do a lot of these like documents and stuff. So I stumbled upon it, and I loved it because like I could break any PDF. Like if you put a control on it, you put something to limit it.
Yeah.
I could use Nitro to break it apart, convert it, and like no other tool really gave me that capability. So I use it for like everything. But I became like a diehard Nitro user.
Oh, wow.
I felt like it was my like it gave me functionality that I just couldn't get anywhere else. So I was just like I was super stoked for a while. And then Adobe like started to like come out with better tools and stuff like that. So now, and there's other integrations, but for a while there, for years, Nitro was the one that I used. I used it like incessantly.
Oh yeah, so, thank you. Yeah, no,
I met the man behind it. So there you go.
I was just a product manager for a while for Nitro, but the real secret sauce for Nitro, honestly, is some of the engineers they have in Eastern Europe who've been with the company for 10 plus years and who are really experts in the PDF spec. But today, Nitro is still chugging along. They're a public company in Australia. I think they added e-signatures to the capabilities, and I'm just really happy that the folks who they take a chance on us, they acquired us, and even though I wasn't there for very, very long, I did learn a lot from Sam and the rest of the team in terms of just how to run a business. So I took that forward in 2017. That was when the first ICO boom in crypto happened. And I think I just read this one article one day about, I'd always known about crypto and blockchain and Bitcoin, but I as an ex-finance person, I was super skeptical about it. They actually posted my Facebook from 2013. And I was like, how do I find a way to short Bitcoin? So luckily I didn't actually short Bitcoin in 2013, but I actually wanted to back in the day because I thought it was complete scam. But what happened was, I think in 2017, I read these articles more about Ethereum and how you can use smart contracts to, basically create programs on the blockchain that didn't require humans to be involved. And to me, coming from the finance world, being parts of lots of securitizations and creating lots of SPVs and all kinds of basically very paper driven entities. I was captivated by the appeal of smart contracts, and so that's what led us to create a company called Coin Alpha, which is basically the company behind Hummingbot. I started it with two friends of mine, my friend Carlo, who I know from college, who had a similar background to me. But had studied computer science in school, so he was very technical. And also Martin, my friend who was working at Apple, who had basically built this machine learning trading algorithm that he had created. So the three of us created Coin Alpha, and the original idea behind Coin Alpha was to create a on-chain hedge fund. The idea was to basically take Martin's quant trading strategy and put it into a smart contract, and then allow anyone to be able to invest and redeem using a smart contract, using Ethereum, and skip all the cost of creating a vehicle, like a hedge fund normally. Because today, if you try to create a hedge fund yourself using, set up an SPV in the BVI, hire an administrator, a custodian, an auditor, you're probably running at $100,000 plus of costs, just to get set up. And before you can even, actually start trading and raising capital. But even then, a lot of hedge funds, it takes a month to get in and redeem. And honestly, it's just in my opinion, a lot of useless paper pushing. And so what we want to do is create a smart contract that allowed anyone to just subscribe and redeem using Ethereum. And the way it worked is we were actually trading on Gemini, and we had a bot, this algorithm that would automatically, predict the price of Bitcoin using Martin's machine learning algorithm, and then would automatically place trades to switch between US dollar and Bitcoin automatically every 15 minutes, depending on the prediction that was made. And then the smart contract, it would pull the NAV using Oracle from Gemini into the smart contract, which would allow people to subscribe and redeem on a daily basis at NAV. And the smart contract calculated the management fee, the performance fee, the high watermark, and all the variables used in accounting for a hedge fund.
Cool. And so then how did that switch over to Hummingbot?
That's a great question. So here's what happened. So the hedge fund part of the strategy actually did pretty well. I think we made something like 23% net of fees in a year when Bitcoin and Ethereum were down, a lot. This was 2018.
Nice.
So, however, what didn't work was actually convincing other hedge funds to adopt this protocol. Because that was the original goal, and the reason was because we were targeting traditional hedge funds in the equities world and the fixed income world. And I still remember this one hedge fund manager said to me, he said, "This is a great idea. This would save us a lot of operational time and cost. However, if I told my LPs that I'm switching over our administrator from some trusted third party to a smart contract, they're going to run for the hills." Because the last thing
I can't imagine why.
Yeah, no, I can't imagine why either. So and he said the last thing my LPs want me to do is focus on cost cutting when I should be focused on building a better strategy. And we heard that time and time again from other hedge funds as well. Meanwhile, I was out there at crypto conferences, really pushing this fund protocol, as we called it. And one day I got a letter from the SEC, and it said, Securities Exchange Commission Enforcement Division. And the letter said, hey, it looks like you're doing something called general solicitation because you issued a hedge fund, you registered using Rule 506B, which doesn't allow hedge funds to solicit generally. But I see all these videos of you at conferences talking about this fund protocol. There's a contact form on your website, and please come in and talk to us and tell us what happened. So at the time, we weren't that worried actually, because we had hired Oric, this great law firm, and we figured that Oric had given us good advice on how to set up the hedge fund, and they could help us, resolve this misunderstanding with the SEC. So over the next 6 months, we flew to DC, paid our Oric lawyer, $1,000 an hour to join us in those conversations. And we had lots of discussions with the SEC. And after 6 months of all this, and lots of legal costs, I think we had paid about $300K in legal fees at the time. The SEC said, we know you guys didn't do anything wrong. You weren't trying to do anything wrong. But you did have this contact form on your website. You did talk about this thing in conferences. We think we have a case here. So why don't we have you settle for $50,000? This one of the smallest settlements ever, and please close down your fund. And so at that point, we had because of the money we had spent and the prospect of dragging it out in further litigation was incredibly unappealing. So we said, sounds good.
I can't imagine why.
Sounds good. And so we closed down our hedge fund.
Yeah, for $50,000, that's better than going back and forth one time with your attorneys, right?
Yeah. But honestly, this costs us.
Can we do that without the attorneys?
Yeah, this cost us a lot of heartache, honestly, because this also really distracted us from actually running a startup and do all these things. Luckily, at that point, we had already raised our seed round from Bain Capital Ventures, so we had more than $2.5 million in the bank. And so at that point, even though we had shut down the fund, and frankly, this fund protocol idea, we knew it didn't really have any legs anyway. So we knew we had to pivot to something else. And so at the time, we just decided to open source our tech stack and just kind of allow anyone to use this kind of like this technology software we had built that automated the running of an algorithm and the ability to place orders on the exchange and kind of like compute and just really manage that whole process. And the reason we open sourced it was because what we realized was a really big pain point we had was just integrating an automatic program, a process, via WebSocket, which is a streaming kind of data connection interface, with a cryptocurrency exchange's API. And the reason is because there were many exchanges, even back then, there were like dozens of cryptocurrency exchanges. Every exchange had a slightly different API. The documentation was very lacking. Even today, a lot of exchanges are lacking in APIs. And so, but in order to actually trust that you could actually have this process running automatically, trading real money, it took us at least over a month of solid engineering time just to build the integration, test it, and resolve all the different bugs and edge cases involved in that integration. And so what we found was, this was incredibly boring, really just soul-sucking work from an engineering standpoint. But it was you had to do it before you could trade. And every single hedge fund, every single individual trader out there was doing the exact same thing. And so we had no idea how we would make money. Our VCs asked us this question, how are you guys going to make money off open sourcing this thing? And I honestly, my answer was, I have no idea. But
volume.
Yeah. Well, but at that point, after going through the whole SEC experience, having spent a year creating this protocol that no one except for us wanted to use, just creating something useful was what we wanted to do. So we open sourced it, but then interestingly enough, we actually got paid a Dove grant from 0x, one of the early decentralized exchanges, to add this strategy that they wanted us to create called basically cross exchange market making. Because the idea was they were creating this decentralized exchange, and this decentralized exchange had very little liquidity on the exchange. So we came up with a strategy where we created a bot that would use the order book from Binance, which was a more popular centralized exchange, and it would use the information on the Binance order book, and it would basically mirror those orders on the 0x exchange order book. And so we call this cross-exchange market making, which is still one of the most popular strategies of Hummingbot today. And it's run by a lot of individuals. In this case, you're kind of like taking liquidity from a very liquid exchange with very tight spreads, and then you're basically remarketing that liquidity onto another exchange and posting wider spreads. And so because you're posting orders on the exchange, I can explain how this later. This is what you're acting as a market maker. You're not taking orders from the exchange. You're basically providing orders on the order book. You're more kind of like offering that to more wider population. So the idea is that you can use information on a very liquid exchange like Binance. When you post wider orders on the more less liquid exchange, if you're filled, your bot can automatically hedge on let's say the more liquid exchange at a tighter spread, and then what you're making is your arbitrage difference in the middle between the wider spreads posted on the small exchange versus the tighter spreads on the more liquid exchange. So we found was a couple of things we found interesting. Number one, a lot of individuals were interested in running this because they had access to these small exchanges that maybe due to geographic reasons or because of the blockchain aren't available to the wider trading firm population. But the second thing was interesting was we found that exchanges themselves were really interested in this because a lot of small exchanges, let's say you're starting exchange yourself, how do you actually provide liquidity? How do you ensure that your order book has sufficient depth for people to come and trade? They have to run some type of algorithm themselves to do that. And so when we kind of came out, there was no other tool available open source that allowed people to do this. And so we found a lot of our early users were the smaller exchanges themselves.
Oh, wow. So the idea of doing a wider spread is really just to build out the depth of book, not to present the most competitive spread, because that's on Binance.
Right.
But if you want to post liquidity, if you're trying to encourage that kind of liquidity, you're trying to provide that depth of book, at least you can provide the wide basis so an order can so you can get a better, tighter spread at the top of the book. And then it just sort of executes across the depth of the book. So
yeah, that's right.
All right.
That's right. Yeah,
makes a ton of sense.
And just to add on to that, I would say a lot of small exchanges, like they're starting order books, they're completely empty. So it's kind of like if you're a new exchange for the first time, there's nothing on the order book at all. Having some orders is better than no orders. And the second thing is that
having been the general counsel of an exchange, I can tell you that the mantra is always liquidity begets liquidity. And of course, then how do you get liquidity? It's like, I don't know. But if you get liquidity, you'll get liquidity. But if you don't have liquidity, you don't get liquidity.
Yeah, that's right. And the other thing I would point out is
this is a way of bootstrapping.
Exactly. It's a bootstrapping liquidity method. But the other thing is that a lot of small exchanges aren't directly competing with Binance or FTX because a lot of them are like local exchanges, like Indodax in Indonesia or PDAX in the Philippines that are only available to the local residents of that country. A lot of fiat-based exchanges are like that. So in some ways, they're not their audience, their user base is very different from the global Binance user base, but they still need an algorithm, some type of technology that allows them to automatically place orders on the order book, adjust them as markets move around, and also make some money from doing so because they can post wider spreads and hedge tighter and actually clip an arbitrage profit from any fills.
Right. And they're providing, and we'll get into this, they're providing a market clearing function, a valuable market clearing function. So, the arbitrageurs in this case are actually performing a positive service. I mean, you can make a case sometimes they don't, but in this case, they're clearly providing a positive service because they're providing that depth of liquidity that otherwise doesn't exist and provides a competitive marketplace for it. So
that's right.
Yeah, spot on. Awesome. So I guess we'll keep rolling through here. So let's talk a little bit about because we were talking a lot about market making and also arb trading, and there's distinctions, right? So there's in in a regulated market like the US market, you have registered market makers. And part of becoming a market maker, you have certain privileges that are associated with being the market maker. You may get different positioning when an order comes in for a book. You may get certain feeds that you wouldn't normally get. There are certain advantages that you get, or else you wouldn't want to become a market maker. You would just have all the burden of being a market maker and none of the benefits. So that's the purpose of market making. Those benefits are typically accorded by a traditional exchange. And so in the context of a digital asset marketplace, those benefits, they're still benefits, but they're not as developed. Liquidity is more bifurcated. Maybe that those benefits aren't as concentrated as they are in the U.S. markets. But do you want to maybe talk about the distinction between market making and arb trading, as opposed to like a traditional U.S. based market?
Yeah, definitely. So the way I explain this is that I think the nuance that I think your viewers should appreciate is in my opinion, the key difference between traditional kind of equity exchange in the U.S. and a digital asset exchange, to me, is a term called direct market access. And what that refers to is that in a traditional equity exchange, typically the market makers, the folks who can actually have access to the order book, who can place orders onto it, are only they call designated market makers. And this history really stems from how the New York Stock Exchange and the original equity exchange were actually formed, because they were actually formed by the market makers themselves. Before the NYSE was started, it was a bunch of people on the street outside Wall Street, on Wall Street, basically, waving their billets around, getting people to trade with them. And then one day they said, why are we standing out here? It's really cold. We're all decentralized and no one can find us. Why don't we rent a building and all operate together? And so everyone can come in and trade with us on the floor of a building. And that became the NYSE. So because the market makers were the ones who set up the original US exchanges, they clearly did not have a huge incentive to let other people, market make onto their order book. And so that's why the concept of specialists, which turned into DMMs or designated market makers, has always been a feature of US equities exchanges. So that's why, market makers have certain privileges, but also means that no one else besides the market makers have those privileges, can actually access the order book. And this has actually created a bunch of scandals in the history of the New York Stock Exchange, and led to lots of regulations. But overall, it's a highly regulated market, which is also why it's standardized and works very well for the immature equities market. When digital assets exchange came around, I think the Wild West was Mt. Gox back in 2012, 2013. And every single year since then, there have been more and more digital asset crypto exchanges being produced. And that's really because digital asset exchanges are just a computer program running on a server. It's a server that allows people to connect to that server via API. And the people connected via API, can basically access the order book, place orders, take orders, and just interact, and so in some ways, my view is that digital asset exchanges are much more of a pure exchange. It's almost analogous to how ad tech exchanges work, where it's a free open marketplace. Everyone can connect to it programmatically via API or via the user interface and post orders and take orders. But overall, I think the key difference between a digital asset exchange and a traditional equity exchange is really about direct market access. Right now, every single crypto exchange has open APIs that are free data feeds. And so, in my opinion, for smaller trading firms and for individuals, it's a more level playing field. And there's also just more opportunities available than if you have to go through a designated market maker in the case of equities.
Right. And so in that context, you still need market makers though, right? That's the thing. Like, somebody, right, that market clearing function, that liquidity provision, the stability mechanisms, arbitrage traders provide that. But particularly when you have an ICO, an initial offering, then it's more important than ever to ensure that there's some stability. Otherwise, you might just say, okay, we're public, and oh crap, now we're zero, and we have more headaches today than when we went public.
Yeah, that's right. Yeah, and actually, the one thing I would point out is that I think the way the market makers operate today is that they do both market making, providing liquidity, and they do arbitrage, typically in the same strategy.
Right.
And the reason is because they're not playing a single exchange game. They're playing a multi-exchange game. So typically, as a market maker, the way you operate is you have certain assets, you have a pool of assets, and your goal is to take those assets and place them on different exchanges. Those exchanges might be centralized exchanges like Binance, or they might be decentralized exchanges on the sitting of blockchain. But in either case, there's an opportunity cost for me in terms of which exchange I place my assets on, or I guess which chains in the case of DEXs. But the strategies I pursue are fairly similar in each one. I can do single venue market making, in which I'm kind of placing a two-way bid and offer spread on one exchange, hoping that the market stays range bound. In which case, the market goes back and forth. I buy low and sell high on one exchange. But obviously, I'm incurring risk by that strategy. So I can also do arbitrage, where I have some assets on one exchange, some assets on another exchange, and then when prices deviate on those two exchanges, I buy low and sell high. I make money from arbitrage. But I can also do a combination of the two. So cross-exchange market making is a combination of the two, where you're making a market on one exchange. As you get filled, you hedge on another exchange. And so it's kind of like, I would say, the traditional view of market making is that you're providing liquidity to a market, you're sitting there and you're taking risk, and every single time the market moves up or down, you might lose money. So market makers tend to, the traditional view is you either place liquidity, but when times are volatile, you step back, you kind of like widen your spreads, or even you stop providing liquidity altogether. But in the more kind of like the more sophisticated quant trading view of market making, you have your assets on a bunch of different exchanges. You're hedging your risk across each one. And you're just looking for opportunities to make small amounts of money by arbitrage, by providing liquidity and hedging. But in your overall, you're monitoring your overall inventory across all exchanges from an overall risk perspective.
Right. But in a traditional market, when a market maker, particularly with a initial offering, they are going to have they are generally going to get additional benefit, maybe directly from the issuer, to sort of sit in front of an oncoming truck, or to make sure that the oncoming truck doesn't run over. And that's part of widening your spreads too, because like if you're fighting, and it's all part of the strategy. Like if you're trying to keep an aggressive quote, and you have to keep on jumping back, then you could burn a lot of capital, where you might just be better off just sort of like sticking your stake at the one price and saying it doesn't go below here, and we come in with size if it starts to move. I mean, there's so many different ways to cut it up. You can't even summarize it, but
I totally agree. If you're market making for a brand new asset, it's the first time this asset has ever been traded publicly, then yes, you're taking a lot of risk, because there's no information on how that asset will trade, and you can't hedge that risk on another venue by doing some type of cross-exchange strategy. So absolutely, the very first time an asset is being listed, the market maker is taking a ton of risk. And that's why in traditional equities markets, there's all this, like, there's a roadshow before the asset, is listed, where there's a lot of price guidance, a lot of like research, and that all that is a process designed to give the market and the market makers information on how to, provide liquidity for the asset over time.
Right. And then once you get past that initial stage in the crypto space or digital asset space, I mean, in many ways, if you're a market maker, if you're on both sides of the quote, I suppose that's one way of saying it's a market making strategy. You're both sides of the quote. And if you're going across exchanges, it's an arb strategy. But in that case, it's a market making type strategy versus, I mean, you may or may not be acting as a market maker. You could be just saying, that's my strategy. I'm like, that's how I'm making money, versus a market maker, which is like a DMM designated. You have a specific function to provide liquidity on both sides of the quote, and within
That's
certain
right.
parameters. I mean, to your point, even sometimes your designated market maker is like, yeah, I'm making your market. And if the market goes haywire, they widen their quotes and just like, what? You're not really my market maker anymore. You're like, your spread is like meaningless. Like you're giving me no support. You're just moving the quote all the way down and staying wide. Those are crappy market makers. It's like, we're a designated market. Right. We're a designated market maker, but we'll just widen our spreads and just walk you all the way down and not really provide that liquidity. Like, oh yeah, they got the back end liquidity, but it's the depth of book liquidity, like the way deep book liquidity. But that doesn't really mean a difference if you're like,
you point out a really this is actually one big issue because and I call this, it's really about kind of like it's really the principal agent problem because as a token issuer, typically it's actually the tokens that are hiring the market makers today because they're coming out for the first time, they're listing on exchange, and they because their asset is completely unknown, they need to hire a service provider to provide liquidity to the token that enables people to actually trade their token when it's listed. And so they end up hiring a market making firm, and these are hedge funds essentially, like Jump Capital, Wintermute, or GSR are some of the larger ones. But these play the same role as Citadel or Virtu in traditional markets, where they are, and what they're supposed to do is they're supposed to actually provide liquidity to a token, and they're supposed to adhere to certain obligations. Like, I'm going to provide this much depth with this much at this type of spread, and I'm going to guarantee something like 95% uptime. But here's what happens, because what the market maker is doing is they're placing orders on the order book, and the customer, the token issuer, typically has no visibility into what the market maker is doing other than this monthly report they're getting at the end of the month. In addition, the model that a lot of these market makers use is something called the option model, where they get an option to, because they also need tokens in order to actually provide their services. The token issuer gives them a bunch of their tokens and a bunch of Bitcoin or Ethereum or stablecoin to provide the other side of the trade. And the market maker is taking the issuer's assets and providing liquidity with those assets. And the market maker is incentivized by having essentially a call option where they can essentially keep the tokens and give back the initial dollar amounts, and keep the tokens as their fee. So what happens? What has actually happened is that the market makers have, because they can price that option better than their customers can, because the market makers are hedge funds. They have basically figured out ways to essentially make a lot of money if the token price goes up. Because if the token price goes up, the market maker just exercises the option, and takes all the tokens, and they can keep it. But if the token price goes down, the market maker doesn't lose anything because they can just give the tokens back to the issuer. And so, unfortunately, it creates a perverse incentive for the market makers. Also, because they don't have to report. They just report once a month. A lot of the market makers, the top firms don't do this, but there's a long tail of fairly, shady market makers that frankly just keep the tokens when the market goes up, and when the market goes down, they just stop providing liquidity because they don't have an incentive to keep on doing their job. So this is actually, and I think the kind of opacity and the shadiness of the industry, this is actually another reason why we open source Hummingbot, because we saw this happening. This has been happening for years and years, and a lot of token projects were my friends who were startup founders trying to create new Web3 business models, trying to create crypto projects that were trying to do the right thing. A lot of them I felt were being taken advantage of by these hedge funds who understood finance better than they could. And when markets went up, the market maker made a lot of money off the token project. And when markets went down, the market maker just didn't even do the job. So I felt that by open sourcing this tool, that it will allow people to do market making for themselves or allow new market making firms to enter the industry, it would kind of open up the market and decentralize this very opaque industry.
Right. And Hummingbot also has some programs where it encourages like the Hummingbot users themselves to to act in that market making role, and it could be used, like I think, sporadically. It could be used, various times to provide liquidity, stability. Why don't you talk a little bit about that and how that's worked out?
Yeah, that's right. Yeah, so remember when I said that our VCs were asking us how we're going to make money off this of this open source software, and so when we first launched Hummingbot in 2019, we didn't really know how to do it. So after a few months, we started to figure out that we had this growing community of people, both individuals and small trading firms who are using Hummingbot to basically provide liquidity, sometimes for their own projects, sometimes just as to make money. And then on the other side, we knew a bunch of token projects who were trying to find an alternative to hiring Jump or GSR as market makers. And so we thought, what if we could create some type of community-based model where people could run Hummingbot and earn some type of reward for providing liquidity, and the reward would allow the token issuers to basically get liquidity for their tokens, for their markets, without having to sign up and be dedicated to one single market-making firm. So we wrote a white paper in October 2019, and the title was Liquidity Mining, a marketplace method, a marketplace-based method of compensating market makers. So this was a pretty technical white paper because we outlined a mathematical model where you could take a reward pool and allocate that according to different order book snapshots. So the idea was, if you took an order book, you could see where all the orders were in that order book, and let's say you could take a random snapshot on average every minute on that order book. If you knew whose orders were in the order book, you could basically allocate a small reward every minute to people based on how tight their orders were and how large their orders were. So we're actually using some of the same kind of contracts that market makers were basically using in terms of adhering to certain spread, uptime, and depth obligations. But we were trying to create a decentralized model where it's almost like anyone can compete to provide that liquidity. And so the way we thought about it was, as a liquidity provider, I'm earning a yield based on the capital I'm putting in, based on the liquidity I'm putting in. And then for the token issuer, I'm seeing a reduction in slippage based on the orders. I can kind of mathematically measure all of this. So as a side note, I think this was actually the impetus for the term liquidity mining in the crypto industry, which has unfortunately ballooned into into a much larger and frankly a much sketchier type of activity that happens on DEXs and everything else. So we've actually stopped using the liquidity mining term. However, the platform that we created as a product of this, which is called Hummingbot Miner, is still around. And every day we have thousands of people running bots, thousands of bots providing liquidity to dozens of individual markets. So right now, I think if you just look at the Miner platform, currently there are 1,092 bots providing $314,000 of liquidity to about 50 different individual markets on 4 exchanges. So for example, Avalanche is one of our customers.
You said $314,000
dollars liquidity. Yeah.
You said 314,000.
Yes. So okay. the amount of liquidity is not that much, but the reason why it's effective is because it's really serving the long tail of markets. So for instance, we have about 50 different markets on the Miner platform. The average amount of liquidity in each one ranges from 5,000 to 25,000, provided by 10 to 20 bots each. But because these are smaller markets like XCAD USDT on KuCoin or Front BUSD on Binance, and our customers are the token issuers themselves, or on Sendex, we have a bunch of campaigns as well. It allows individuals running Hummingbot to kind of put their capital at risk to earn kind of token rewards paid from the token issuers. And the token issuers, for them, it's an alternative to hiring a single hedge fund. Now they're getting access to a wider community of people providing liquidity. So in some ways, it's not just a liquidity provision function, but also a distribution and marketing function, at the same time. So a lot of our customers like Avalanche, iExec, Front, they also hire a market maker as well. in addition to using the miner platform to get community-based liquidity.
Right. And 314,000, the impact of it is magnified, obviously, if it just keeps on refreshing, right?
That's right.
Execution refresh, and it just may be reflective of the market. Market starts to get bigger, start bigger names, it grows and contracts. And so I totally get that. It's magnified in its importance.
Yeah.
And so this basically allows an issuer, like depending on the platform that they're going to be working with, if they have a relationship with Hummingbot, or I guess even if they don't, they could actually, leverage this pool where market makers could provide stability for their project. They could even assess what kind of you could have different rewards programs, et cetera. You can gauge how much depth of book you're going to get, responsiveness, and then you've got another source of liquidity stability for your project when you launch, and a diversity of that, so you're not dependent on one person suddenly ghosting you and like, oh no.
Yeah, that's right. Yeah, that's right. And our goal was really try to create a two-sided marketplace. So kind of take the Uber concept or the Airbnb concept and apply it to market making, so that people can provide liquidity on one side, on the supply side, and on the demand side, whether the exchange or the token issuer, they can access the marketplace to get liquidity instead of being constrained to a single provider.
Right, and this definitely serves a different purpose than like AMMs as currently utilized.
That's a great question, because I view AMMs as a different exchange model. So just like you have the order book model on centralized exchanges, the AMM model is kind of like a different exchange model. But ultimately, exchanges are always still, you need both makers and takers to make the exchange work. So what's interesting is that on the order book side, because you have retail people coming in and buying and selling, those people are dependent on orders on the order book. And those orders on the order book, you have to have a bot basically that's constantly refreshing them. The need is for makers. However, for AMMs, the inverse is true, in that in an AMM, it's easy as a liquidity provider. You can almost be a retail liquidity provider by just depositing your tokens into the AMM and you're earning a yield for providing liquidity. But a lot of AMMs have a dearth of actually takers. They have a dearth of arbitrage bots that are coming in to take the other side. So we're actually about to kind of launch an experiment with Avalanche, where we're going to incentivize the same types of, basically get people to also run bots, except people are running arbitrage bots and providing the volume that allows kind of Avalanche-based dexes to, thrive and get more volume, and kind of fill the missing gap, which is on the taker side as opposed to the maker side.
Interesting. So I was I was general counsel of a direct edge exchange for a number of years, and also did some ATS stuff. But I remember just the whole maker taker price incentivization model. That was like that was an art form. Like we had different exchange platforms with different maker taker ratios. Sometimes it'd be you're negative on one, you're positive on the other, and it would attract very different types of liquidity. Some would be more retail focused, some would be more hedge fund focused, or So it's just it is an art form. And I remember there was one guy in our shop. He was like the artist. Like he would know incremental pennies and understand. It was very complicated. It wasn't just like saying, oh, we're going to put a number here, we're going to put a number there. It was like, no, we're going to tick it up by like a quarter of a cent on one or like 1 basis point or whatever. It was just nuts. So that wasn't a quarter of a cent. That actually was a lot for if it was per share.
And actually, building your point, I think that I think the overarching thesis, and this is why I'm so excited about Hummingbot, is that it's kind of like, it goes to that theme of direct market access. It's kind of like, if anyone can create an exchange, you have all these different exchange models proliferating, but all these different exchange models require, makers and takers for them to actually function. And so what ends up happening is that our product, Hummingbot, is kind of like a piece of software that matches the long tail of exchanges with the long tail of both individual and professional trading firms that are looking to operate and make money off these small exchanges. Because our users on the user side, they're typically not the retail Coinbase, folks who just like to click around and punt on, like goblin profile pick NFTs. Instead, they're the people who, as you said, like they study exchanges, and they really like, get off on the fact that they spend hours like figuring out like some minor rebate on one exchange, and they set up an arbitrage bot that allows them to make 10% like per month on the capital for a while, and then that opportunity expires, and they have to go and find more opportunities like that. So it kind of like appeals to this like the engineer / trader persona that almost approaches trading as like playing RPG, like playing a game, as opposed to something that they have to do.
Yeah, right on. That's so. And we touched here on the community. So let's talk about the community for Hummingbot. You've described it as, I guess, maybe not. Some cases full-time trader, sometimes just somebody who comes home and just it's another really exciting way to play and make money in a much more structured way. Arguably, if they get it right, there's much less risk. It's like you figure out the game, you can make the money without the risk because you're providing that market clearing function, and you're not exposing yourself on one side or the other. What are the benefits that they get as being part of the Hummingbot community? Like, is there more that they like? Describe what it's like to be that user and what you gain out of it.
Yeah. So on the community side, this really stems from kind of the history of open source projects, which open source hasn't been a huge part of finance, but it's been an incredibly massive and large part of Silicon Valley for the last 20 years. And our inspiration has really been projects like Linux or Apache Spark, which have basically created large community-based ways of maintaining a certain software code base. So, for example, Linux, when Linux first launched in the early 90s, it was basically this command line clone, Linux, like a Unix clone that was really hard to use. But if you're a Linux user today, you have this incredibly powerful graphical interface that's almost indistinguishable from Windows or Mac. And it's because over the last 30 years, this community of people have contributed lots of different things completely for free, into Linux. Like different drivers, different pieces of software, like packages, and they can do that because Linux has a very modular architecture, and there's a really vibrant open source community of developers who are contributing to it. So we designed Hummingbot in a similar fashion. So the different components we have different connectors to exchanges. We have centralized exchange connectors, and we have decentralized exchange connectors. And then in addition, we have strategies that people can contribute that allow them to basically do various things on those exchanges. And we just introduced a new component called scripts that are like light versions of strategies, just like snippets of Python code that are simpler for people to create. And so because we have these different kind of components, we try to give incentives. Well, when we first started, people just contributed these things for free. But today, because we have an open source foundation with a governance token, we can use a token to kind of create incentives for developers to come in, contribute different components and also to maintain those different components. So that's just a recap. So today, I think we have about 30 official centralized exchange connectors. We just started the decentralized exchange connectors, so we have like 5 or 10 of those, and we have about 15 to 16 different strategies in our code base. But we expect these numbers to exponentially increase over the next few years as kind of like the system kind of grows, and as kind of like the HBOT token incentive model continues to mature. And we believe that over the long term, Hummingbot will look something like Linux, a community-based project that allows any trader to do any trading strategy on any exchange.
Excellent. And while we're talking about that, let's talk a little bit about maybe institutions' usage of the platform. Now, I think it's really designed more for the institutions. They tend to have a very proprietary view of the strategy that they develop. Like the game is like, hey, if I develop this phenomenal strategy, then the value is that nobody else has it. Although, realistically, there's probably some components of that just make it easier for others. And maybe by being part of the community, they could benefit, or they could even leverage like benchmarking components of the community. Is that so? What's your thoughts on that kind of engagement and the value to sophisticated institutions?
Yeah. When we first started, most of our users were individual, but over time we've seen a greater number of institutional usage, and they use it. A lot of times they're only using certain components they need. For example, exchange connectors. So a lot of time they'll just use the connectors, so they don't have to skip. They can skip the integration with exchanges, but they're adding their own strategies and keeping those private. In addition, a lot of them do use our strategies, but because our strategies are kind of programs with different parameters, they can keep their configuration files secret, while just using the open source software. So right now, a number of the larger market making firms in crypto are actually run their businesses on top of us. So some of the names I can name are System 9, 3Jane Capital, CTF. These are kind of like public names, and we think also there's a long tail of other firms that are just using our code for free, not reporting any volume into us, and just keeping up with the updates quietly. But overall, we don't mind that, because I think that's part of being open source software. And the way we look at it is, there's many protocols, there's many exchanges out there. But Hummingbot, if we're the largest open source ecosystem, and we connect to all the exchanges, all the protocols, over time, as long as we can, build a sustainable ecosystem, as long as we can kind of continue to make money off of the exchange partnerships, as long as we can continue to get the token out there and allow people to actually govern the project, over time, we do look like something like Linux, whereas it's an open source client software that allows people to kind of like interact with all the protocols and exchanges out there.
Yeah, and I mean, I think, longer term, the incentive for these sophisticated institutions, even if they want to retain their proprietary code, like the benchmarking component of it could be significant. Like, hey, I developed a strategy. You could utilize some of the benchmarking components. You could have different traders also trying to break it or trade against it, or create volume on a benchmarking strategy. I mean, in terms of making it the core piece of your value add, your alpha, I mean, you could leverage a lot of testing resources effectively and say, hey, I got the strategy, and maybe put it in a sandbox and let others just go to town without necessarily revealing the whole code. To me, that seems like there's definitely something there, because I can't imagine, because institutional traders, they got all these guys that are focused. Like, if they're really smart, they're trying to create that alpha, but but who's doing the testing, right? Like, I've been in a lot of organizations. You're like that. Everybody who wants to move to where their value creation is, and then when it comes to the benchmarking side, they're like, oh, well, we'll create this other unit or something. But it doesn't always have, or you have the guys who are creating it also create the testing, which isn't really the kind of diversity you want in testing it. You want to get people jazzed who are from the outside and saying, yeah, I'll beat these guys. I'm gonna break their, and that's where you get really some, that's how you have more rigor to your benchmark testing, right? As opposed to just even.
Yeah, absolutely. And just to build on your point, people may not be aware that a lot of the key strategies in quant trading are actually public, because they're based on an academic paper that was written, and the paper kind of outlines the main model for the strategy. So, for example, one of the strategies we're most proud of is called Avellaneda, and it's based on probably the most classic paper in market making by a folks named Marco Avellaneda, who unfortunately just passed away earlier this year, and Sasha Stoikov. So Avellaneda and Stoikov are two of the most famous kind of academics in quant finance. They and a bunch of their peers have written papers that describe models for market making, models for arbitrage, and basically kind of apply a very theoretical academic treatment toward market making. However, until we came along, there were no public GitHub repositories that actually outlined how you actually ran the model and actually parameterized it and actually ran a program against it. And so we spent a lot of time to kind of model the Avellaneda strategy, both in the pure mathematical form, but also creating kind of easy to use parameters like spread that allows individuals to use that model without having to understand all the math behind it. So, and I think that's an area of research and development that we would love to work with more professional trading firms on, because it's not just Avanade. There's other papers like Gwent, the newer models coming out of kind of like Chicago and Stanford that I think, are really interesting to model. And so in the future, as Hummingbot develops, we hope to work with universities, trading firms, and other research organizations to just basically expose and make more public how quant finance actually works under the hood.
Excellent. So, and so we talked a little bit about AMMs and centralized exchanges. And yours is sort of like a different take, right? Because it's almost like DeFi, right? It's not DeFi per se, but it's decentralization, bringing the power of decentralization, a decentralized community to a more centralized system to kind of facilitate that. And I think you said you were also now considering how do we also use that from the other side of a DeFi. So, one point that we had talked about too is that on exchanges, the use of Hummingbot would also substantially reduce conflicts of interest. So if an exchange is providing liquidity or has an arm that provides liquidity or an associated firm, there are potential conflicts of interest in terms of access to books. And, is it, what kind of access are they getting? Is it preferential? Are they getting, is it actually being used against it? But again, by sort of opening it up to this broader community with a lot of different competing interests, it sort of it reduces the ability that any one, centralized market maker with preferential access or somehow related to the exchange where it's being listed might have.
Yeah, that's right. And so we talked a lot of exchanges, and in my view, a lot of exchanges, they're just startups trying to do the right thing. And because it's an unregulated industry, a lot of them, I would say, the reason that some of them provide their own liquidity, they run their own market making, a lot of times is because there's a dearth of market makers out there, and they can't hire or find enough market makers, so they're almost forced to providing liquidity as a way to operate their business. But obviously, that creates conflicts of interest with their users, and as the industry gets more regulated, I think we'll see provisions in place that basically say, if you're running exchange, you have to leverage external market makers, and you can't be trading your own book. So I think it's a good thing for the industry, because if there are more tooling out there like Hummingbot, there's more market makers who can access the order book. And I think there's an advantage in having, because I think there's an advantage in having this free and open marketplace where it's anyone can provide liquidity, anyone can take liquidity, and the exchange is basically it's just a flea market that makes money by connecting both the providers of liquidity and the takers of liquidity in that venue. And so I think that right now, I think obviously the market is still very much Wild West, but over time, and I think that the advantage of this model, frankly, in my opinion, versus a traditional model where only certain people can create exchanges, only certain people can provide liquidity, is that you see a lot more variation in terms of the types of innovation that happens. So right now, obviously, we have the AMM, which was a new type of exchange that really seemed to work. Another invention that was created by crypto was perpetual future, which because it allows people to create derivatives that don't have expiration dates, it don't have strike prices, and avoids all this like complication that exists in traditional instruments. And we're also seeing the same thing being applied to options now. And so it's kind of like, in my opinion, a lot of things that happen in finance are because people have always done things the way that they used to. And there's kind of like because people aren't able to create these new financial primitives, a lack of innovation has perpetuated the industry for the last hundreds of years. And it wasn't really until people started to basically create these new designs on the blockchain, figure out if they work or not, and just basically allow traders and developers to code against it, that we're finally seeing innovation being unlocked in finance. And so that's what's important to me. It's not so much whether it's centralized or decentralized, but it's not like, what are the new models coming out? And are there people who are able to kind of solve the chicken egg problem by providing liquidity, taking liquidity, and just seeing if these new primitives and new exchange models actually work.
Excellent. So a couple things I want to cover. One is I want to touch on sort of the current environment, right? So in the current environment, um, maybe there's trends that you're seeing. Certainly, I know in traditional equities, when you start to get a lot of volatility in the market, you typically would see market makers widen their spreads, which could be equivalent to even not being there at all, just pulling it off the table because they're just like, okay, I'm going to go when I understand the market a little bit better. I want that sort of steady state. I don't trade. There's vol trades. Like market makers, you would call them volatility traders. Are you seeing like a shift toward other strategies? Like, for example, oftentimes a volatility trade is like an ignition or momentum-based strategy, as opposed to a market making. Have you seen that kind of shift amongst the strategies being used or asked for or discussions, or how has that sort of played out on your end?
I would say I think there is something going on because but the way I look at it is more around. I think that this is also caveated by the fact that our users are the long tail. So our users are not just providing millions of dollars of liquidity to the Bitcoin pairs and Binance. They're really looking for opportunities to be like big fish in small ponds. Kind of market make for small tokens on small exchanges. So what I see from our community is that a lot of them are looking at the interplay between centralized exchanges and decentralized exchanges for small tokens. Because what happens today is that, in the past, before decentralized exchanges came along, a small token would have to list, and pay a lot of money to market maker to list on a centralized exchange. But today, a lot of them list on a decentralized exchange, like Uniswap, PancakeSwap on Binance Smart Chain, or Trader Joe on Avalanche. And then that's the first step. And then afterwards, they're listing on a centralized exchange as a second step. So what that means is, as a market maker, you always have two markets you can kind of like play between: the centralized markets for a token and the decentralized markets for a token. And so because the decentralized markets rely on arbitrage, so anytime the centralized exchange moves, it creates an arbitrage opportunity between that and the decentralized exchange. Meanwhile, because you already have the decentralized exchange in there, you kind of already have some history for the token before it hits the centralized exchange. And so, and this is also why in Hummingbot, we've really prioritized adding decentralized exchange connectors so that our users can basically provide liquidity on both centralized and decentralized exchanges while hedging on the other side.
Excellent. And then I guess the last thing is just what are your short to medium term goals for Hummingbot? I think you touched on some of them, but maybe we just sort of summarize them directionally.
So I would say, like, the first thing is I think that we just launched the Hummingbot Foundation, which is an open source. It's kind of like modeled after Linux Foundation. It's an open source foundation that's the steward of the Hummingbot project. So the goal there, and that's also what the part that I'm more involved in. Because we've separated the business from the for-profit liquidity provision service side, which is Coin Alpha, from the open source side, which is Hummingbot. On the open source side, our main goal is to expand our kind of like our community on both the exchange side and on the user side. We're still entering into partnerships with different exchanges, both centralized and decentralized, so that our users can actually supply more liquidity and volume to the exchanges and do more programs. Some of the programs we're launching, we're actually launching something called a bot camp, a developer boot camp that teaches people how to write Hummingbot strategies, and also teach them how to actually do quant trading from a theory standpoint as well. And so developers who pass the course will get some HBOT tokens, but we're also give them a certificate as an NFT that allows them to kind of like, basically take that certificate and hopefully, be hired by others of the community to build, different integrations or different strategies itself. So overall, I would say on the Hummingbot Foundation side, we're kind of like, we're just basically using this single piece of software, the single code base, to try to expand, on the exchange side, as well as the developer/trader side. But overall, it's only been a few months, but I think the model is working. And the main thing we have to figure out, honestly, is how to add more documentation, how to coordinate all the moving pieces that go into maintaining a global 20,000 member community, and just trying to make sure that basically we can match the developers looking to write strategies, the traders looking to use them, and the exchanges who benefit from all this liquidity and volume.
Excellent. So before we break, anything that I should have asked that I neglected to?
No, actually, I think this was an incredibly fruitful conversation. Hopefully, it was educational for your audience. And the only thing I should mention is that, in addition to running the Hummingbot, kind of like being a board member of the Hummingbot Foundation, I started a Substack recently, and my goal with my Substack is to try to just educate people on how finance works, and how crypto works to people in finance, and try to bridge the gap, because I feel like there's a lot of misunderstanding out there about what the technology of crypto really is on the finance side, and then on the crypto side, I think people don't understand kind of like how exchanges and other financial how the finance industry works. And I think, in my opinion, crypto is really the synthesis of kind of like the blockchain world and the finance world, and eventually we'll all be in the same finance industry. So it's a good time that I think everyone learns about how it works. And so I would encourage people to just check out my Substack. It's Fengtality, Feng, Tality, like the Mortal Kombat thing. But anyway, so it's fengtality.substack.com, and I'm just trying to teach people how it all works.
Awesome, good stuff. Thanks so much for coming on the podcast. This was great.
Thanks, Eric.